Hey guys, welcome back to another live stream. We're going to have some fun tonight, I think. We're going to be talking about things like RSP and VOO. And if you don't know what that is, hang around. Maybe we can kind of bring that to light. We're going to talk about total return. I'm going to begin unveiling this little spreadsheet I've been putting together. It's not that small, but it's pretty cool. And I want to share that with you guys and even get some feedback on that. And then we're also going to talk about your stocks. What are you buying? What do you want to look at? What's on your mind as investors? So it's good to be with you guys again. And so today my day started off really early. I had to leave my house, and I'm retired, remember? So I'm getting too old for this, but I had to leave my house at 5:30, drive up to Tennessee, pick up some items that I need here for the farm. Then I came back, and there was then I got to spend all day with a guy who was putting in some field lines at a house. I've never seen that done. Never really understood how field lines work with like what is that called, septic tank systems. So I learned a lot today, and it was hot, it was dirty, and I'm just glad to be with you guys here tonight. So let's get this show underway. I don't know, you guys ever had a chance to do any septic tank work? That is not for the faint of heart. I promise you that it is not for the faint of heart. So let's see who's on the program tonight. So we've got Kevin Mendoza. So we have at least two Kevins. And usually it takes three to get a full quorum. Maybe we will have another Kevin join us here before too long. And Kevin Mendoza says that he is being charged by Vanguard 1% on his ADR dividends. This is a new fee from Vanguard on international stocks. So is this in addition to the rate that they charge per country? Like, for instance, I think England is there's no tax there, but like Canada, I think is 15%, maybe 15 or 20. So is that in addition to what the country it charges? That's just a Vanguard fee. If so, dude, that is really disappointing. I mean, I don't I don't really invest in international stocks just because of the complexity from a tax perspective. Not everybody really cares about that, but I just try to keep mine as simple as possible. But man, if you're trying to make some money and your brokerage is charging you 1% for every dividend that comes in, I just don't get that. I don't understand why they would do that. So anyway, dude, that's not good. Might look at Fidelity. That might be a good option for you. I don't know, man. Let's see. We got a new face tonight. We have Shannon Galantine or Galantine, not really sure. But hey, it's great to see you, man. I saw you on Russ's broadcast last night, and so I'm glad you're here. I'd love to know more about you. If you want to join the Discord group, there's a link to it in this video. This goes for anybody. If you want to join the Discord group, it is free to join. You just sign up and click on that link, and it'll take you through all of the steps that you need to do. If you have any trouble, let me know. But I'd love to get to know you more and find out what you're all about, what your investing goals are, what you're investing in, and that kind of thing. So looking forward to getting to know you more, man. And John Jay is in the house, and he is also commiserating with Kevin number 2, Kevin Mendoza. So it's good to see you, my friend John. Let's see, what else do we have here? Oscar is in the house. Hey, Oscar, it's good to see you, buddy. It's good to be back. Jim Betts is in the house. I'm sure we can expect a dad joke or two. Not to put any pressure on you, Jim, but you're getting a reputation for this kind of stuff. And, you just don't want to disappoint when you come on a live stream. And, you got to have a joke ready at all times. So there you go. Fast Eddie, good to see you, man. Let's see. Oh, Chris, also known as Kamarai. He is in the house. Good to see you, my friend. And I'd like to hear what you're doing with your Penelec shares, Pinnacle West shares. That's a blast from the past. I think they call that a Freudian slip. Penelec is Pennsylvania Electric, which is not a publicly traded company, but Pinnacle West is the company that Chris and I have in common. So Pat is in the house. Hey, you're late, but you're never late on here, my man. You are never late. It's good to have you here. Slammer 6789. It's good to see you live too, man. It's good to be here on the program with you. Brad Durfee is in the house. Greg has made it. Man, this is a great cast of characters here tonight. We've got let's see. Yeah, Pat says everything is up, so I don't know what to buy. I guess I will stock up on some cash. Hey, cash is never a bad thing. I have a little bit of cash. Maybe we can talk about that tonight. I've got some things I want to talk about, but you just never know where these live streams are going to go. Plus, it's not like anybody's talking back to me, so it just kind of goes wherever my brain goes. So, wow, Cookie Monster, it is good to see you, my friend. Haven't seen you in a while. The honeybees are they're doing fine. I had 4 hives. I think I lost one. I've got to get back in those. I was not able to do that today because of the septic tank that I was working with. But I've got to get in there. Probably do that tomorrow and just kind of get back into the hives and see what's going on. But yeah, they're the honeybees are doing good. But I'll know more next week. I'll give you a more thorough update next week. Let's see. I'm going to pass that up. Let's see. Yeah, John J. Yes, leech lines. That is, they call them field lines here in Alabama, but leech lines is also a term that is used. And so, yeah, absolutely. So Chris says he has no Pinnacle West shares. Not allowed to hold in my 401k. I should have bought some in taxable around 68. Gotcha. So that's interesting. You're not allowed to hold in the 401k. I'm assuming that is work related. So yeah, so that kind of stinks. But I would not suggest buying them here. They are pretty high. So, but they have done well for me in my portfolio. I've been very happy to have them. All right, so let's get started. Here's what I want to do tonight. I want to go and show you guys. I have the wrong thing pulled up, so pardon me for one moment as I present the right screen. We're going to do this. So you see this is what the thumbnail is for this live stream, VOO versus RSP. So what I wanted to ask you guys is, I watched some videos over the weekend. I don't even remember why. I was doing something, maybe driving somewhere, and I just needed to pass some time. So I was listening to some videos, some YouTube videos from some of my favorite people, and they began to talk about this equal weighted S&P 500 ETF called RSP. It's the Invesco equal weight S&P 500. So if you don't really understand what that means is ETFs like SPY and VOO, and I can't think of the others off the top of my head, but those ETFs that track the S&P 500 usually will weight, and that's not W-A-I-T, it is W-E-I-G-H-T. So the holdings inside the ETF will be weighted based on the market cap of the companies in the S&P 500. So what does that mean? That means that Apple, for instance, would be maybe a 7% of the VU of the S&P 500. So based on the market cap of the company, you'll have the top seven, the Mag 7 as they call them, will be the top stocks. And I did add that up earlier, and it looks like maybe the top seven stocks would hold a 30% weight in VU. So it is, it's Tesla and Nvidia, Apple, Microsoft, Amazon, Google, and I'm missing one. I don't remember which one it is. But they hold about a 30% weight in VU. So when you buy VU, you're buying 30% of the 30% of your investment is the top seven stocks, right? This RSP is an equal weighted S&P 500. So it basically takes the S&P 500, which is a bit of a misnomer. I think it's 503 or 504 stocks. But it will give each one of those stocks the exact same weighting. So 500, let's say it's 504 stocks. 504, each dollar will be divided by 504, and that's what it gets. So every stock has exactly the same weighting. And so there's been some discussion in these YouTube videos about, well, wait, should we, has AI kind of run its course? Should we shift more toward this equal weight of the S&P 500 and catch maybe some of these lower, smaller cap stocks as they begin their recovery? So I want to find out what you guys think about that. I mean, nobody really knows, right? We're just kind of thinking about the future here and what might happen. So I don't have any real, hard, tangible suggestions for the group. But it's enough to make me wonder, should I do that? So what I decided to do is go to, I did have the right one up earlier. Man, that's awful. Here, let's share this screen here. That's the right one. All right, let's try this. Wow. All right, here we go. We're going to flip over. I know what I need to do. I'm going to move that to a new window. There we go. How about that, huh? That works great. Then I'm going to move this. I should have did all this before we got on here, huh? There we go. Now we're good. So I'm going to flip over to... Now I've lost you guys. I can't see you. There you are. Okay, we're back. So let's flip over here to real quick to, where do I want to go? Let's go to Yahoo. Yahoo works pretty well for something like this. And so what I want to do is I want to take this is the, I'll flip that off for a minute. This is the S&P 500 VU. This is the market weighted ETF of VU. You can see that over the last 5 days, it was a 4.9% return. And just today, Monday, was 0.96% return. So it did very, very well. But when I add in RSP and compare it, so remember, RSP is an equally weighted ETF. We can see that RSP only generated about 0.75%. I mean, it's not too shabby, but when you compare it to the to VU, it falls short. So I looked at that on a 1 day. I said, okay, what is the 5 day? Here's the 5 day. The RSP was 3.7. VU was 4.9. Okay, what was the last month? Actually, the last month is pretty close. 1.3 for RSP. It looks like RSP is the winner on that, though. Maybe it's 1.5 and then on 1.3 for VU. But the last 3 months, VU is clearly the winner, 5.7%. 6 months, VU again, clear winner, 12.1%. And that's not shocking, right? I mean, the entire, premise of the last 12 months has been, the Mag 7 driving the S&P 500. So this is not shocking. This is not anything that you wouldn't have just thought this was just, you would have just naturally known this. So, and then look at the year to date. It's almost double, 9% for the RSP, 18% for VU. The last year, also VU smoking it. 2 years, VU smoking it. It's over double. The last 5 years, it tightens up a little bit, but VU is still, half, 50% higher at 93% versus 65% for the RSP. And if I look at the whole range, this goes back to somewhere in the 2010 timeframe. And you'll notice, though, that, up until January of 2023, well, let's back up a little bit. Up until about 2020, they ran pretty close. So the S&P 500 kind of ran together. And then all of a sudden, it began to take off, and then it came back together near the end of 22, early 23. And then it was like lights out with the top 7. So beginning in January 2023, we saw that move. So what do you guys think? I mean, is that something that we should be concerned about now? Should we think about those of us who invest in the S&P 500, which I do? I have a sizable part of my investment in the S&P 500. Should I consider maybe splitting that between VU and RSP, just to, anticipating that we're going to get some small cap recovery here? What do you guys think? So let me come back to where you guys are, and you tell me. Yeah. So yeah, John J. Yeah, RSP is the equal weighted S&P, and VU is the market weighted S&P. Yeah, VU did much better. That's right, John J. They did. So, but what do you guys think? Should we do something like that or not? I want to hear your thoughts on that. Kevin Mendoza says he's getting some FOMO, fear of missing out on RSP. He says he needs it now. Jim, what do you get when you cross? And here we go, dad joke. Okay, here we go. What do you get when you cross an agnostic, a dyslexic, and an insomniac? Someone who lays awake all night wondering if there's really a dog. I get it, man. That's good. All right, you can go back to sleep now, Jim. You have fulfilled your purpose. No, I'm just joking, man. I need your thoughts on this. So let's see. Fast Eddie says, how many companies drop out of the S&P 500 every year? I think you end up with a lot of dogs in with the ponies, and that's very possible. I don't recall ever knowing that information, but it's probably 3 or 4, I would think, on an annual basis. The bottom of the 500 would kind of float out, and then some others might take its place. But I bet it's somewhere between 3 and 5. Yeah, so Pat loved Jim's things. Never time the market, time versus timing the market. Yeah, no, that's a great point, Shannon. And I don't think that's what I'm asking here. If it's to me, it's asking, this investment versus another investment. It's not, should I have it in cash versus in the market? So, it'd be like saying, should I invest in J&J or should I invest in AbbVie? It's that kind of question that I'm asking, not whether I should invest or not trying to time the market, just trying to determine if the RSP has a better future potential than VU. And I've got some thoughts, but I wanted to hear what you guys had to say. Let's see. So John says, don't waste your time. $10,000 invested in VU. Let's see. Let me do this. There we go. $10,000 invested in VU did much better than RSP. Yeah, no, that's right. That's right. And, part of the challenge is that the past is not always the best indicator of the future, right? So just because it did it before doesn't mean it'll do it again. And so that's kind of what I'm asking, right? So, All right, we got Michael Swami is in the house. It's better late than never, my friend. So it's good to have you here. Yeah. So Greg says no RSP for him, and I think that's where my head's at too. It's so first of all, what we didn't talk about are the fees. The fee for VU is 0.03%. And that's pretty low. I mean, I guess you would call it a non-managed fund, right? It's not actively managed. And I think ex-dividend dad said in the Discord the other day that SPLG is actually now 0.02%. So at some point, maybe these ETFs will be free, but that's kind of where it's heading. But that's not the point. The point is that VU is 0.03%, where RSP is 0.2%. So it is almost 7 times more expensive from a fee perspective to buy RSP than it is VU. So you got that kind of working against you as well. So it's almost like you would need to get not only a better return, but a much better return to cover the fees. So that's kind of where my head's at. I'm just going to stay invested in VU. I'm not going to move any money into RSP. We'll see what happens. We may look back on this conversation and say, man, we should have done something, but I don't see any real triggers to do that. So let's see. Yeah, so this is Greg. Greg says that he is currently looking at small mid-cap ETFs, though, and I agree with that. I think at some point those stocks, now, in higher interest rate environments, those stocks don't do very well typically because it's harder for them to raise capital. But I think, if with interest rates possibly coming down, I think there may be a possibility that they will do well in the future. So let's see. John Jay says, years ago, you always used to hear about Dow Jones Industrial Average. Do you know why now most of the talk is about S&P? Well, I think the Dow had its place back in the early industrial age. So it was really the top 30 industrial stocks. And I think they're not really all industrial stocks now. I don't really keep track of them. But if I'm not mistaken, I think isn't like Amazon or somebody like maybe it's Facebook. I don't know. Like Meta is in there. And so it's just really kind of a goofy thing, I think. So I really don't follow the Dow at all. It is the top 30 or, the Dow top 30 stocks. But I think using 500 of the top stocks is a real indicator of the market. And so that's why I use it as kind of an indication of where the market's going. So that's the way I look at it. Fast Daddy says only 1% of your portfolio is in RSP at maximum if you must. That's good. So I think, Fast Daddy, what I'm going to do is I'm going to do 0%. I think that's kind of where I'm ending on this discussion. And, as investors, one of the things that we really always have to do is question everything, right? And so just because we've done something for a long period of time doesn't mean that we shouldn't question the things that we've done, because there was a book one time that I read, and I don't really remember much about the book, but the title was really catchy. And what the title said was, what got you here won't get you there. And it was about management. It was about, actually I do remember about the book. It was about performing in your job, getting to the level of management, but performing in your job was not the same skill set you needed to go from lower management to upper management. So, if we can borrow that, if we can steal that and apply that to investing, what that would say is, sometimes getting from our first trade to our first 100,000 might not be the same thing that gets us from 100,000 to $1 million. I think we just have to keep learning that, right? We have to keep learning. We have to keep questioning things. because at the end of the day, we're in this to grow and to get better at what we do. We want to be the best investors that we can be. So that's why I asked the question, is because sometimes you just gotta, you gotta poke the bear, man. You gotta poke the bear a little bit. So the second question I wanted to ask today or on the live stream is about total return. So you guys tell me what you use to measure your portfolio. So some people I have seen measure their portfolio based on yield. They would say, "Hey, my portfolio is yielding 4% or 5% or 6%." Or they might say, "Hey, my dividend growth," right? They're looking at dividend growth, and they'd say, "My dividend growth is X." So, is that what you guys use? Tell me what metrics you use to manage your portfolio. What do you consider a successful portfolio? What is it that you would look at if you could look at one metric and say, "I want to look at that one metric and determine if my portfolio is successful"? What would that metric be? So here we go. Honeybee, it says, Honeybee says, "I'm late. Sorry." Well, you're not late. You are just, fashionably late, right? So what we're talking about now is how do we measure our portfolio, right? So is measuring our portfolio something that we use, our dividend stats for? What stats do you use to say I'm doing well, right? I watch a lot of videos, YouTube videos, and some of those it's really hard to determine what they always say, "Oh, my portfolio is doing great," but compared to what, right? What do they use? So let's see what we got here. Michael, it looks like has a very complicated. What is AVUV? Accumulating AVUV every 2 weeks. You'll have to help me with that one, Michael. If I know it, it's in the deep recesses of my mind. CCOI. What is CCOI? Maybe I am the one who's missing out here. Is that a ticker symbol? Is it Cogent Comms? Is that what you're asking about? If so, I'll come back to it here in a minute. Let's see. Let's see, Kevin Mendoza. I remember 3 years ago when Pat Gelsinger of Intel said in an interview when he first took over that the dividend was his priority. Yeah, no, that is right. That's a whole different story, and he wasn't managing a portfolio, but he really misled investors. So that is that's worth taking a drink of Diet Coke on. That's a depressing thought, actually. So not only did he mislead investors at that point, and then they chopped the dividend by 65% or something like that. And then he comes back and now they suspended the dividend. So I don't know. If I were on the board, I would be seeking to find somebody different to run the company, because that's just not good. Aventus. So you'll have to help me with that, Michael. I don't remember what question that's answering. So Pat says, I just can't pick one thing. And that's a fair comment. So small cap value. Oh, so that must be a ticker that you're asking about. Or that you're saying I got you. Okay, I'm with you now. You are accumulating AVUV, which is a small cap value ETF. And so I get it now. I get it. Sometimes I just, the synapses just do not fire correctly. But, hopefully maybe I need another sip of Diet Coke. There we got it. Okay. So Greg says he has a hybrid of low and high yield portfolio. So I like to be above SCHD and still hanging with the S&P as a tracker. Yeah, it's almost like we are brothers from a different mother, um, because that's very similar to what I do. I think that's a good approach to have, and I think um, it's not really either dividends or growth. It's kind of both, right? Um, when I think about my portfolio, I like to think of the total return. So, I do want dividends. I invest in companies that pay dividends. I love that cash flow. I love that camaraderie. I even mentioned some of these on my video the other day. I just really enjoy dividend companies, companies who pay dividends. So it's kind of a basis for my portfolio. But at the end of the day, I don't measure my portfolio on yield, and I don't measure it on dividend growth really. What I measure it on is total return. And what generates total return? I'm going somewhere with this. This is not just for fun, as they say, but I want to show you guys a spreadsheet that I've been putting together. So when I think about total return, I think about growth in the share price as one aspect of that, and dividends as the other aspect. So I can get share price growth and dividends, and then and those dividends can be either cash dividends or stock dividends, but you get the point. And so you put both of those together, and that is the total return that I'm getting from that investment. But what really matters is, what do I think the total return is going to be in the future? Because really all we have to invest on is the data from the past. So how do I then, if I've got a watch list of 50 stocks, what's the next stock on the list? What is the best potential stock out there? So if we were doing an NFL draft and we had the 50 top tickers on our watch list, which one would be next? And so what I've been creating is a spreadsheet that would play around with that. So let me show you that. And I want to get your feedback on it too. I've been playing with it for probably a couple of months now. And so let me see if I can make this any bigger. I'll get Greg off of here. Sorry, Greg. There you go, buddy. So let me see if I can make this a bit bigger. So it drops things off there, but that's okay. You get to see it now anyway. So when I look at, what is the next most profitable potential return? So I have this spreadsheet that kind of calculates this. But what we all know is that regardless of what we calculate for the future, it will be wrong. Any future calculation that we do, if I were to say Johnson & Johnson is going to be X price in 1 year, it will. The only thing I know is that if Johnson & Johnson is that price, it is that price for all the wrong reasons. It will not be for the reasons that I chose. It would only be coincidence. So, it's really about, how do I kind of rank up my stocks so that I'll know which ones and have some theory behind what I want to buy. So when I look at this thing here, I got this total annual return potential. Anything can happen. It can be, there can be fraud in the company, and all of a sudden this goes away, right? There can be a downturn in the economy. This kind of goes away. But when I use it to compare stocks, when I use the same basis to compare all the stocks in my watch list, then I still think it has relevance because it's relative to each other. The stocks are relative to each other. So regardless of whether these percentages come true or not, I think there's still potential for the relative performance to happen. So you can see here that I list out my buys, sells, holds out here. And so when I do my videos on, what are my highest, I haven't done the value stocks yet, but when I do, what are my top dividend growth stocks? What are my top yielding stocks? This is where this is coming from, right? And these are the stocks that I am investing my own money into. I'm not trying to give you stocks just to entertain you. I'm trying to tell you exactly what I'm looking at, because that's the whole purpose of what I do here, is just to share with you what I'm doing. You know, you can do whatever you want, but at least it gives you a perspective from somebody else, right? So, so this is the annual return, and this is total return. So how do I get to that? So I want to share with you this, and this may be a little bit simple, but I really think, what do they say? Simple is sophisticated. So let me shrink this back down a little bit, because I want to share with you how I get. This is the unveiling, right? So, and this might be a little complicated, but it's really not. So the first thing and the easiest part of this is yield. That's in the middle. That is the dividends that are coming in divided by the share price of the stock. So that is the yield. That is what the company is currently paying its shareholders to hold its stock. So we know that if nothing else happened, if the stock was the same price today that it is for a year from now, we will likely get this yield from the dividend. So that's part of total return. That's probably the easiest one of these. The second area, which is share price appreciation, I'm looking at it in two different ways. One is there is a growth in the business. The business is going to grow because we are picking quality companies who have solid strategies, solid management teams, solid balance sheets, and they are growing their business. So how do I determine how much that business is going to grow? Well, what I've chosen to do is to use dividend growth as a indicator of business growth. And I could take you through the math, but I will save you from all of that. But if the payout ratio stays flat and they're growing their dividend by, let's say, 10% per year, chances are the business is also growing by 10% per year. So if that's the case, I think I'm pretty good saying, hey, the business is going to grow by 10% a year. The other piece is, you know, based on the current value, is it undervalued? So what's the value of the stock today? If the value of the stock today is $100 and it's trading for 80, at some point, if the intrinsic value calculation is correct, it's going to come back to that equilibrium of $100 a share. Might take it a while because there may be issues, right, that's causing it. So I consider maybe a 4-year time frame for them to recover that undervalue. So I'm looking at them recovering their undervalue plus growing the business plus the yield. And so all of those together is total return. That's how I come up with this total annual return potential. Then I sort that in descending order. And I determine my buys and holds and sells based off of that. So I think I'll stop there. There's a lot to the spreadsheet. I've hidden most of it just because, you know, it's just a lot of math. But the other cool piece of this is now I can make this spreadsheet even bigger, because up until this past week, I've been manually updating the data. Now I have ways to pull data from the apps that I have, and I can pull that into Excel, and it actually populates all of the pieces of data that I'm looking for. So anyway, sorry to ramble on about that, but I'm excited about that. I think it's going to be a cool tool to use. And let me see if there's any comments on that. Any comments on this spreadsheet? Am I missing anything here? Is there something that you guys think of here that I may be missing? So let's see. Let me do this right here. Kenny Eugene, finally caught one of your lives. Sorry, I entered a little late, but I'm interested in your thoughts on covered call ETFs. ETFs. Okay. Well, that sounds good. I'm going to go back and capture a few of these comments from earlier that I said I would come back to. I try to be a man of my word, right? So let me see if I can find one. Somebody asked for one earlier, and I said I was going to come back to it, and now I don't see it. Maybe I should have. There's a way that I can mark these, but I forgot to do it on that. Yeah, I'm not seeing it. So if you know who that was, and if you could put it back in the comments, that would be awesome, because I really wanted to come back to it, but now I don't remember what it was. Oh, this might be it. What do you think about CCOI? So CCOI, let's go ahead and move to some of my apps here. I'm going to get rid of this spreadsheet, and I'm going to share this screen here. All right, here we go. You guys ready? CCOI, it looks like it's Cogent Comms. Looks, the analysts are saying it's got about an 11% downside. So that's not too exciting, although it went up 3% today. Let's take a look and see what I know my buddy Russ would say this is doing a Kevin Burgess, but I really want to know what the market value or what the intrinsic value of this is. So according to Morningstar, the fair value is 75. It's trading around 75, so that's not terrible. That's very doable. And one more stop before we make a conclusion, and that is Simply Safe Dividends, CCOI. So they're considered borderline safe. They've got a yield of 5.2%. Let's look at their dividend history. They've got some nice growth. The other thing I would look at is their payout ratio. Yeah, the payout ratio looks really bad. That's wild. Their payout ratio, they must be losing money, because their payout ratio is a negative 157% and a negative 80% for the let's see if they're, oh yeah, here we go. Look at these earnings per share. There's something wrong in Denmark, as they say. So I would really want to understand what's going on with that stock. And they're considered borderline safe by Simply Safe Dividends, but it's not anything that I don't think I would entertain it as a stock unless I really knew what the issues were there. So that's what I think about CCOI. Okay, what else do we want to talk about today, guys? Let's see. Let me catch back up here. So this is Jim. He says his E-Trade platform will compare his results to the S&P 500, which is why I measure my investing success. But annual dividend payout increasing year over year is more important than beating the S&P 500. I get it. Yeah, we're in very similar situations there, so that's a good approach. Synapses aren't always there, my friend. That is true. The older I get, the less they fire at will. Sometimes they fire on their own, and sometimes they don't fire at all. So let's see here. Yeah, there's a lot of comparison to the S&P 500, and to be honest with you, when I was younger, that's what I would compare to. Now that I am retired and I'm looking at my portfolio differently, if I compare it to the S&P 500, and if I want to beat the S&P 500, it drives me to make different decisions than I really need to make at this point in my life. So that's why I don't compare it to the S&P 500 anymore. I tend to, as Greg said earlier, use SCHD and even DGRO. I tend to use that as well, and I'm usually somewhere in between those. So All right, let's see. Oh, Rust Moments made it. Shaping has made it to the group, so good job. Okay, so Kenny, we're back to you, my friend, on the covered call ETFs. So my thoughts on covered call ETFs are that I typically don't like them. And so why is that? I know that they can create a lot of current income, and you would think as a retired guy that would be very attractive to me. But again, I'm not measuring my portfolio, my return on the yield. If I was measuring it on the yield, I might make decisions that would be detrimental to the overall portfolio value. So covered call ETFs, for those who don't know what those are, covered call ETFs are ETFs that hold shares in companies, and they will then leverage those shares. They will typically sell covered call options on the shares that they own. Now, what covered call options do is they will say, I will give you the option. They are selling the right for someone to buy their shares at a strike price. Usually that's a bit higher than where the current price is. So let's say that the stock goes up dramatically. And I know there's some risk mitigation processes. So you options guys out there, just give me a little bit of grace here, a little bit of leeway. But if you know, if there's a let's say the stock's trading at 50, and let's say the call option is at 55. So I sell you the ability to buy my shares at 55. Let's say the stock price jumps overnight to $60, jumps 20% from $50 to $60. We have that option contract in place. So I pay you $55 for your $60 stock, and you give me my shares at $55. I now have a $60 stock that I paid $55 for, minus the commission I paid you for the option. So that's what covered call ETFs do. But if you think about what that is you are giving up when you do a covered call, when you sell a covered call, you are giving up your future, the upside. You're giving up the upside for a premium. That premium is like an insurance premium, so the cost of that option. But you are holding all of the downside risk because they are long in the stock. So if the stock drops 20%, guess what? They got the premium, but they also got the 20% loss. So, but if the stock goes up 20%, they only get half of that in our example here. So hopefully you can see why I don't really like that. I am a buy and hold investor. I'm not a buy and hold forever investor, but I am a buy and hold. I'm a long-term investor. So I like to own the shares. I am an investor. I'm not a trader. And so I don't really want to be playing around with the holdings that I have and giving somebody the ability to take it away from me. So sorry about that rambled on, but it's kind of the way I feel about it. All right, so Shannon, good. I'm glad you like the sheet, man. I'm going to continue to refine it, and it's going to take some time for it to really kind of, and I really need to start saving versions of it so I can go back and say, it's been 6 months. What has it done compared to what I thought it would do? So it's going to take some time for it to really show its value, but we'll see. Yeah, it's a thing of beauty. It's the colors, man. The colors always do it. Finally made it. I wasn't able to comment earlier. Hey, legendary. You are legendary, man. It is great to have you here. And I'm glad you like the spreadsheet. I'll keep refining that. Let's see. Oh, Jim says that Seeking Alpha likes CCOI with 3 buys. Okay. Well, there may be something there. I mean, obviously, I didn't read. I don't even really know what they do. It has something to do with communications. But there's something going on. They are losing money for a reason, and it may be a short-term thing. And if that's the case, then you might feel okay with it. But I would certainly try to figure out what that is. Good, Kenny. I'm glad you like the spreadsheet, man. I might make this available for some people at some point. I don't want to just throw it out there and give you guys something that's not going to work. I want to test it a bit. But if it's something you'd be interested in, shoot me a note or something. 421% payout ratio from Seeking Alpha. That's weird. So, yeah, I don't know. I would want to make sure I understood the numbers too, because sometimes if apps have different numbers, that means that they're playing around with the numbers a bit, and you might be worth taking a look at. What am I seeing that's still a buy in a market like this? This is ex-dividend dad. It is good to see you, buddy. I don't know. I tell you where my money is going, and that is, but you guys already know this. I bought, when was it? Last week sometime. I bought Visa. Every now and then, as Hess Midstream takes a dip, I will buy some of that just for the income from that stock. And I did buy some Lamb Weston to average down. I bought some at 55, and it is now, what is it now? It's now back around, pardon me while I look it up. I think it's around 62. I will check that really quick, though. Yeah, 62, almost $63 a share now. So my break-even price is somewhere around 69. And, if you haven't caught my video on Lamb Weston, you should do that. But it was really, a stock that I'm really having to work hard to get this back to be profitable again. And it's getting there. I mean, I'm down, 10% maybe, 7%, something like that. So that's very reasonable, very doable. So, but back to ex-dividend dad, the Lamb Weston, I would consider I like the long-term potential for Lamb Weston. I do think that there's some management issues there, but we'll have to see what the board does on that. But so I think that is a buy. I think Visa's a buy. I think Hess Midstream's a buy. I am buying Verizon when it hits around $39 a share. I'm not buying it at 40. I'm buying it at 39. So I haven't bought any in a little while. But let's see who else. Now I picked Visa over MasterCard, but MasterCard is almost the same company. When you look at just the numbers they look almost the same. So, for me, there's 6 in one, half dozen in the other. I picked Visa. You might want to pick MasterCard. You might pick them both. I don't know, but I think they're very, very similar. Another one that I think is a buy is Microsoft. I have not picked any of that up because it has come back a bit from last week. So I'm kind of holding off on Microsoft. There is a couple of, I still think U.S. Bancorp is a decent buy. I might wait a little bit and see if that comes down a bit. And I have bought recently United Parcel Service. So those are the buys. Those are my only buys, ex-dividend dad. Out of my watch list of 53 stocks, I have 1, 2, 3, 4, 5, 6, 7, 8. I have, oh no, not 8, 7. I have 7 buys out of 53. So that's not a very high percentage. What is that? Maybe 15% of my watch list that I would invest in at the moment. So yeah, it's out there, man. Yield chasers beware. Absolutely. That's why I love to look at total return, because if you're just looking at the yield, it is not a good way to go. Oh, and you're specifically talking about CCOI. So yeah, no, that makes a lot of sense. Russ, my buddy Russ. Hello, Indiana Burgess. Yeah, you like my hat? I got this hat when we went to Jackson Hole, Wyoming, and I just love it. So I don't even wear it. It's a leather hat, and it is so hot because it just keeps all of the heat inside of it. So I don't wear it outside. I mean, it's been 100 degrees here in Alabama, so I might wear it in the wintertime, but right now I'm not wearing it. So what do I wear it for? I wear it for you guys. I wear it for this video, and that's so I'm gonna keep doing it until I decide different. Oh, you've got a real question here. Made it just in time. Do you have time to give a quick thought on pool? Pool. Well, let's give it a shot. Hey, my buddy Russ, I'm gonna do a Kevin Burgess just for you. All right, let's take a look at Pool. So Pool Corp, it is a consumer discretionary. I will switch back to this. It has a 69 dividend safety score, 1.39% yield. Let's see what the dividend growth has been looking like. Man, it is looking really sharp. Look at the growth, especially here recently. Now, let me see what they do first. This is a true Kevin Burgess here. Pool distributes swim. Oh, what a great name! Swimming pool supplies, equipment, related leisure products in the United States and internationally. It offers maintenance products, so chemical supplies, pool accessories, repair, replacement, pool parts, filters, cleaners, pumps, lights, the whole deal. So now at least we know what it is. So look at these dividends, man. They are growing like crazy. So the last 5 years, 20%. That is pretty fast. And currently, the latest was 9%. Oh, so in my model, what I do to be conservative is I will look at the last 5 year average annual change in dividends and the last year, whichever is lower is the one that I use for the model. So it's I'm trying to be conservative. So dividend growth streak is 13 years. They've had an uninterrupted dividend for 19 years, so that's not too shabby. Their expense ratios or their earnings ratios look fine to me. Let's see, the shares outstanding are coming down. The ROIC, which is a big metric for me, it's at 22%. It's actually a little lower than what it has been, but that's a smoking good return on invested capital. So I don't see anything wrong with that. They've got net debt to capital around 48%. So that may be a little bit on the high side, but it looks like they have the ability to manage that well. Their interest coverage ratio is about a 12. So let's see what the value is on Morningstar. And the Morningstar does not cover it. So I typically don't trust their quant numbers here. Their quant's at 371 versus 345. So if they don't cover it, they don't even give any analysis on it. So there's not really any help that we can get from Morningstar. Let's look at Fastgraphs then. Pool. Fastgraphs would tell us that it seems to be a little bit on the pricey side. Looks like their earnings have come down since 2022. It may be that with the pandemic, people were staying home, not going on cruises and stuff and buying pools. And so their earnings went way up. Now they're maybe recapturing some of that, getting back to a normal cycle. So that might be worth taking a look at. But according to Fastgraphs here, it looks to be a bit overpriced, even from its normal. So the blue line would be its normal PE ratio. Let's skin this down to maybe a 10. So maybe it's not, it's not way off from the last 10 years, but it's still, it's still not a screaming value buy. But if you think the future is bright for pools, hey, it's not a bad Not a bad stock to look at. I don't know if I'm going to put it on my watch list because it just seems to be a little bit pricey. Plus, it's had this dip in earnings, and I'm not really sure what that's all about. So I would need to research that some more. So hopefully that's helpful. I don't know if it is, but let's see. Russ says 27 watching and only 10 thumbs up, 10 likes. What the heck? So yeah, if that's a great reminder. So if you get a chance, if you can hit that thumbs up button, that would be awesome. Let's see. Let's see. You guys have some conversations going on, which is good. Yeah, so Kenny, yeah, absolutely. I mean, glad to give my thoughts really on anything. So if you ever want my opinion, I usually have two of them on everything. So I've got one opinion for it, one against it. So no, I'm just joking. I will give you what I really believe, what I truly believe, not just to hear myself talk. So glad that was helpful. And the cool thing about it is we get to run our own portfolios. We are our own chief investment officers. So in that role, you'd have the authority, but you also have the responsibility to do well as a chief investment officer. So you got to do your own due diligence, and that's what I try to do. That's what I try to instill in the folks that are watching. Let's see. It's time for a drink of Diet Coke. Man, we've been going for an hour already. Let's see. Here's Jim. Thoughts on CNQ and Vici. I have to look at CNQ. I'm not pulling that off the top of my head. Oh, that's why. It's Canadian Natural Resources. And I would just say off the top of my head, looks to be doesn't look to be very exciting to me, Jim. Just in terms of future growth. So, but Vici, I know there's a lot of people that like Vici. Or I'll just pull it up real quick. There's a lot of people that really love Vici properties. I'm not one of those. Vici has, just from a price perspective, it's just been very flat. I think in order for them to do well in their niche, they're going to need to create some partnerships. They're going to have to grow their share price. They're going to have to grow their equity, and I'm just not feeling it. So. But if you want to invest in Vici, that's great. It's a great ETF for. It's a great REIT. It's got a cool space, there especially in Las Vegas, and those cool buildings that are there. But I just, I think there's other places that we can make some money. So I tend to stay away from Vici. So those are my thoughts. Yeah. Ex-Dividend Dad says, don't let Len Weston become an old girlfriend. And no, I get it, man. I get it. And you and I have had some discussions about old girlfriends. So that's great advice. I will certainly take that. But at this point, I'm still going to be courting her. So let's see. Good call on LW call asking about opportunities. How's Airbnb? That's Airbnb. Yeah, I don't know that one. I just don't get excited about Airbnb as well. So Airbnb. Let's see what Fastcraft has to say about it. They seem to be pretty pricey, but they've just got a bit of. It's just unpredictable to me. This is adjusted operating earnings, so. I'm just not too excited about it personally. And let me come back here to John J. John J is asking thoughts on FFLC versus VU. So let me see what Fastgraphs does not track ETFs. So let me come over here. FFLC. Fidelity Fundamental Large Cap Core ETF. Dividend growth is minus 50%. That sounds pretty rugged. Yeah, let me see if there's let me go to here. FFLC. No. Yeah, FFLC. This is the chart, and I will go out to let's go 1 year. So for about 35%, that's not too shabby. 5 years, 107%. Year to date, it's up 23%. 14. Yeah, I mean, it doesn't look too bad. It just that dividend dropping 50% sounds a little weird to me. It seems like if it's a fundamental large cap core ETF, I would expect the dividend to be much more consistent. So I would want to kind of dive into that a little bit to understand that piece. That's the only thing. Let me find you guys again. Here you are. Yeah, LW on a DCA. I think that's right. I do think that Lamb Weston has good long-term value, but I don't want to mislead anybody. There needs to be a management change there. Either that or we had to start eating a lot of French fries. So, that's anyway. There you go. Let's see here. Get rid of that commercial on there. That was distracting even me. Let's see. Yeah, Russ says, and we're loading it up with stocks, and we got 5 minutes left. I'm 6 minutes over. Yep, John J. Even Ryan did 1.5 hours on Friday, and Russ did 1.5 hours. So, what are you guys trying to say? Should I go 1.5 hours? We only have 20 folks left, so. Oh, good. Michael Swami finally picked up some UNH, some United Health. That might be a buy for me if I didn't own, if I wasn't already at a full position in it. But it's good. I mean that they're a bit overvalued at the moment, but man, that dividend growth is incredible. 12%. Yeah. So, which is what he said in the next comment. So that's good. Oh, absolutely, Russ. Anytime, my friend. A pool is a hole in the ground into which you pour money. That's good. I like that, Michael. Let's see. Yeah. In a recession, pool companies are no bueno. That's good, Michael. I like that. Yeah, Shannon, it's good to have you, man. If you want to join the Discord, there's a link in the notes here. And I'm going to see if there's anything else here before I sign off. Let's see, SUVs and some. Oh, yeah, that's not a good sign, Michael. The gas utilities customers are getting late notices in the summer. That's not a good sign. I agree with you. Kevin Mendoza says we need a 2-hour stream. I tell you what, my friend, if we're going to do a 2-hour stream, I'm going to have to plan for that because my I know this is weird, but the this camera that I use, it's much better than the camera that I used to use, but it will not record with the power cord plugged in. It runs off a battery. So the batteries that I have will last about an hour and 20, hour and 30 minutes. And so if I get close to, as a matter of fact, my red light is blinking right now because the battery has run down. So I mean, I have more batteries here. It's just a matter of me disappearing for a minute as I replace batteries. But it's something that I would have to plan to go for 2 hours, if nothing else, just to figure out the quickest way to replace a battery. Oh, Sergio, this is a great question. Have I ever reviewed EOG? And I don't know if I have. I own EOG, but I don't know if I've ever reviewed it. It is it's a oil and gas exploration stock. It was a spinoff of the old Enron, and has been an incredible investment for me. Um, so they when things are well, when things are going great, they pay a special dividend. There were times the yield for me was going at about over 10% per year just on special dividends plus their normal dividend. And so it was just this high yielding, high growth stock, and it was really kind of sweet. That's slowed down a lot now with the economy, but yeah, I own EOG. Might be worth doing a video on. I'll write that down. Uh, EOG. Sounds like there's some folks that want a video on HESM as well. So I'll look at doing videos on those. Let's see. Yeah, that's right. Last remnant of Enron. All right, so fantastic. I think that is it for tonight, guys. It has been a great program. And, as I continue to get this spreadsheet kind of lined out, I'm going to continue to share that on the live streams, and then may even make it available to some people. So anyway, with that, my friends, I'm going to get off of here, and I hope you have a great week. My next video is going to be about my top value stocks, which there's really not that many, maybe two. So it's going to be a pretty short video. But anyway, with that, I'm going to sign off here. I hope you have a great week. Let me know if you have any questions on the Discord, and I will see you on the next video.